Hello, everyone. My name is Ronald Lund, and I am recording my final presentation for managerial finance in the Mount Mercy MBA program of spring 2022. This will encompass a financial overview and analysis of the Home Depot Incorporation and Lowe's. Diving in, Home Depot was founded around 1978 in the United States in Atlanta, Georgia. Much like Lowe's, this retail giant sells home improvement goods and other tools or necessities needed to basically get a job done, whether it be from renovations to paintings or craft supplies, gardening tools. They have a large market that encompasses everything around the home. So much like Lowe's, Home Depot has markets that expand outside of the United States. They are recently getting into the Chinese market, but they can be found all over North America with strong footholds in Mexico and Canada. So the priority of these organizations are to accomplish and develop a praiseworthy execution of services by utilizing vital drives, specifically in emphasis on generating a higher profit margin and increasing revenue as well as profitability. So with these two major retailers, an expansion in the quantity of stores could potentially increment deal turnover, and secondly, an association of decisively broad board members are seeking to potentially make a focus on clientele and laborers in which they would be able to utilize void retires solely after the end of business. So with the foundation of Lowe's is also a major chain of supply stores focusing around the sector of home improvement and redesign. So with the Lowe's Corporation, they have some expertise in home apparatuses and gear for further developing homes in some. And in spite of the fact that it is situated in North America, the association of Lowe's has stores in Canada and Mexico as well, with the largest foothold being in America. However, they are expanding internationally as well. A contextual investigation might show that it is the principal business operation or opponent towards Home Depot, as they are often seen as the two largest rivals in this service sector. Lowe's technique often depends on opening new stores that would empower the firm to accomplish development paces of up to even 18 to 19% versus the Home Depot. It likewise intended to zero in on a metropolitan place to set apart by enormous human populaces. More noteworthy, they are focusing on development in urban sectors that have populations of 500,000 or greater, and a portion of the urban communities that we're focused on in comparison towards Home Depot, as Home Depot is seeking to expand into more rural areas or smaller size scales, very comparative to Cedar Rapids or Iowa City, whereas Lowe's is zoning in on places such as New York, Boston, Los Angeles, or Houston, Texas. And additionally, the administration of Lowe's is seeking to develop deals through another promoting framework that would make numerous clientele purchases items separate from the organization, and valuing procedures were taken on a draw end of clients with cutthroat costs of differential items. These two major organizations are sourcing their items from abroad. Typically, a lot of their costs of imports are down currently with our current international and retrospective global relations. But likewise, the administration of Lowe's and senior leadership is visualized working on deals with separate firms by acquiring critical pieces of the pie, so to speak, particularly They are seeking to set strongholds and footholds in the northeast and western coastlines of the United States. So with that, diving into a ratio analysis of Lowe's and Home Depot, it is very apparent to see that over the COVID-19 issue that we had on a global perspective, that these two firms are increasing their revenues and profit margins as more people are seeking to renovate their homes and do DIY home improvement projects. Current market outlooks and conditions for both of the corporations are pretty high, in essence, that they both are seeking profitable returns and margins that are record numbers. And Lowe's company is producing a rather rave of the moment take in the home improvement business because it is separating itself from Home Depot and potentially giving customer service. This would be very apparent in their ratio analysis that Lowe's is very capable of fulfilling a record amount of customer demand for home improvement products and services. And we have seen an increase and spike through the years 2018 to 2021. It is important to note that fiscal year 2022 is not yet closed, so a lot of this data is driven from last year's. So because of advancements in retail marketing and other different practices behind Lowe's, Lowe's has delivered a high rate of return of results in 2020, and they had seen a 54% increase in adjusted diluted earnings per share, raising this cost to $8.86 per share, further driving the total sales growth of 24% on a comparable sales growth of 26%. And it also saw a 47% increase in adjusted operating income. Lowe's also has seen an increase in sales and revenue by over 20%. And this can be brought upon that they have a greater service and higher in-stock order quantities, as they often keep the majority of their supplies on surplus in the brick and mortar stores rather than a distribution center such as Home Depot. And regarding their superior inventory management, this has allowed them to facilitate transactions on a faster realm. And Lowe's had a reported revenue for 2021 of $89.597 billion, and this was seen as a 24.19% from 2020. This is an astronomical amount. It's not necessarily depicted in that it is due to COVID-19 and more people being at home, maybe driving an increase in desire to renovate their home spaces, but it is definitely something that has pushed them to the top of the market currently. And this can be demonstrated by a debt to equity ratio further, and calculation had shown that Lowe's debt to equity ratio of 2021 was zero, a flat zero. And this is great because this suggests that Lowe's doesn't need to borrow any funding or cash to expand their expenditures or even expand the business. So they are limiting the investment returns that may be earned and passed on to shareholders. This would make it a very viable stock purchase and something that myself, I would prefer, as it just further shows that I would get more of a bang for my buck. This value of zero has remained extremely consistent over the last decade, and there was an abnormal drop experienced in July 2021. However, that is even better, but it has since returned to a normal ratio amount of zero. A current ratio that was shown at Lowe's was 1.4 in 2010. This was an abnormally high amount that was experienced again in the mid-2020s, but Lowe's current ratio as of October 31st, 2021 was 1.19, further detailing that Lowe's has enough cash on hand to stay afloat for the short term. But as we had demonstrated with their revenue from 2020 to 2021, this is most likely depicted that they are able to do this for much longer than a short term of 6 months to 12 months. This could also indicate further that they are in a strong position financially by their quick ratio value of 0.39. However, this number could be troubling to some, as it might indicate that Lowe's has more liquid assets than liabilities. And what I took from this is that it further indicates that they might not be experiencing a high amount of sales or collections on the accounts receivable, more the latter, that they might not be receiving a high amount of collections. This value has remained relatively inconsistent over the last decade. It's all over the place, with a low of 0.10 in July 2015, and they had a high peak of 0.65 in July 2020. So overall, outcomes of Home Depot have remained relatively consistent to that of Lowe's, and they have also experienced a net sale increase of 21.9 billion to a total amount of 132.1 billion in fiscal year 2020. This was also a very high improvement of over 20%, but this was from fiscal year 2019. And what this had further shown that by Craig Minar, who is the CEO of Home Depot, and he felt that acquisition of the Home Depot supply places the company in a dominant advantage to pursue rapid revenue growth in a $55 billion industry that is largely undefined. Although I don't necessarily agree with him in the fact that it is undefined, I think there is a strong market encompass, and typically for market shares and clientele who might come into the realm of wanting to make a purchase in this industry know what they want, or generally have an idea of what they want to do. For instance, you don't walk into a home improvement store wanting to buy a plant and then leave buying brand new cabinetry on a typical standpoint. If I were doing a comparison to Target, however, that might be a little bit different for me. But the next monetary transmission strategy, followed by Home Depot, would be to increase its dividend with earnings. So Home Depot had asserted that it has a great and good financial condition after the fiscal year of 2020. And what this had indicated to me was that a robust profitability creation and that capital investments were restarted in the first quarter of fiscal year 2021. So in essence, they're making a lot of money. But for the 3 months ended on October 31st, 2021, Lowe's had a debt to equity ratio of 35.47. This suggested a major risk factor for Home Depot that its lenders, since it implies that the firm is financing a major amount of its funding to its prospective expansion. So I think from this, and what I had taken, is that they are trying to compete on a global scale with Lowe's, in that they are over borrowing or potentially expanding way too fast. And what we have seen from companies in the past is that you never want to expand too fast, because the debt may not be able to be made up in the short term, and it could cause a potential financial collapse in the short term. So this debt could also be passed on to its shareholders, which is something that would be a major turnoff in me buying or purchasing stock of Home Depot. This value has remained extremely consistent over the last decade, in between a value of 1 and 2. With a very abnormal drop experienced in July 2020. However, it's since moved to an abnormally high value. The current ratio for Home Depot was significantly higher at around 1.55 in 2012 and has since gradually gone down and declined. But there was a brief spike in October 2021. The current ratio was 1.13 as of October 31st, 2021. And what this had depicted for me is that the Home Depot has enough cash on hand to stay afloat in the short term. However, with their rapid expansion, it makes me think that they might not be able to do this for the long term if they stay on a trajectory of what they are right now. But as of October 31st, 2021, Lowe's had a quick ratio of 0.37. And this number was very troubling in my research. And it was very much like Lowe's in that it might indicate that Home Depot also has more liquid assets than liabilities. So further indicating that they are not experiencing a high amount of sales or collections on the accounts receivables. But based on revenue, I don't necessarily think it's the amount of sales. I think it's the collections on accounts receivable that they are not experiencing a high amount of, but this value has overall remained relatively inconsistent over the last decade, with a low of 0.24 in 2009 and 0.26 in 2019, experiencing a peak of 0.74 in July of 2020. And this has kind of set on a target or track that between the two, I'd currently rather purchase Lowe's stock. And the reasoning for that is that they seem like they are in a potential draw of financial standpoint. But Lowe's and Home Depot are both prominent retailers of the home improvement stores in North America with a rapid global expansion. But in the construction industry, both corporations are previously and still are major competitors. It is noted that we have seen other organizations try to enter in the market or already be in the market, much like a local favorite of Menards. However, they are nowhere on the scale that Home Depot and Lowe's are on top of sales and overall revenue. So various suggestions that I had found in each firm might be offered. Information on the accounting assessments conducted in this paper shows that construction hardware stores also have a lot of space to expand, and both firms are currently working to improve customer experience and grab bigger portions of the potential market. But drawing at all this and kind of identifying which stock or company I'd rather buy into or purchase as a shareholder, I had identified that I'd rather purchase Lowe's stock. And my rationale for that is that Lowe's companies is currently a cheap stock to buy. So, and this would be according to the evaluation criteria proposed that we had to cover in this paper. The stock has proven extremely valuable, and Lowe's also has a financial standing and development opportunities that show it can create a long-term value. So holding on to my stocks could make me a significant amount of money in the long run. And as a result of the ratio analysis through Lowe's companies, I think it is a much better investment than Home Depot. Although the main argument for this decision is that Lowe's does not borrow to sustain expanding expenditures because they are very much in a similar financial situation. They are very neck and neck. I would say, though, Home Depot is number-wise and maybe cash on hand a little bit better. But I think Lowe's is taking over the market in that they are able to provide a better service and draw in more sales. But Lowe's also has a little larger profit margin than Home Depot. So every other characteristic of the Home Depot and Lowe's basically remains the same. And this had proven to my argument that it had come down to whether one gained a better incentive, which I had Lowe's had the greater average of earning surprise, lower PE ratio, a higher VGM score, and it also has a faster expected EPS growth over the next 3 to 5 years. So in turn, purchase Lowe's stock over Home Depot. I definitely think it provides a greater bang for your buck in the long run and ultimately provides maybe more incentive to kind of get into that market. I think it definitely is an interesting one in that critics may say it's largely undefined. However, I think it's defined in that the clientele is maybe the one aspect that is not. So further suggestions for improvement would be to increase maybe a more interactive marketing strategy, just because I often tend to think that clientele bases are limited in the home improvement sector because a lot of people don't know what they're doing. So maybe some educational opportunities as well would provide a further room in growth area for return on revenue or profits. So thank you so much for listening to me, and I hope you all have a great rest of your summer, and it has been amazing learning with you all, and I sincerely wish you all the best of luck as you finish out your MBA here at Mount Mercy.